Hey everyone, in the world of investing, we all want to peek into the future, right? While we can't predict everything, there are tools that give us a hint of what's to come. These tools are called leading indicators. Think of them like clues that tell us about future economic growth and good investment opportunities. By understanding these clues, we can make smarter investment choices. These indicators aren't perfect, but they give us valuable information about where the economy is heading. They help us see trends early and adjust our investment plans. They're like an early warning system telling us about possible booms or busts. Whether you're an expert investor or just starting, understanding leading indicators can give you an advantage. It's like having a secret weapon, helping you navigate the market with more confidence and potentially earn more money. So, let's explore the world of leading indicators and how they can help you make smarter investment decisions. Get ready to learn the secrets of predicting industry growth and set yourself up for success in the exciting world of investing. One of the most important sets of leading indicators comes from the Institute for Supply Management, or ISM. They publish monthly reports on manufacturing and services, two big parts of the US economy. These reports are like the economy's report card, showing us how healthy it is now and what might happen in the future. The ISM Manufacturing Index, which you often hear about in the news, tracks factory activity. A score above 50 means growth, while below 50 means shrinking. This index gives us a real-time check on the manufacturing world, which is really important for understanding economic growth. The ISM Services Index looks at the health of the service sector, which is a huge part of the US economy. This index tracks things like shops, healthcare, and finance, giving us a good overview of consumer spending and how people feel about the economy. These reports are full of valuable data for investors. By looking at trends in new orders, production, and jobs, we can predict industry growth and find good investment opportunities. It's like having a backstage pass to the economy, letting us see what's really going on. So, next time you hear about the ISM reports, listen closely. They hold important clues about the future of the economy and can help you make smarter investment decisions. Keep an eye on these reports, and you'll be ready to navigate the changing market. Now let's talk about the value chain. This is really important for understanding how industries work and where the good investment opportunities are. Imagine the value chain as a relay race. Each runner adds something to the baton before passing it on. It starts with raw materials, like digging up oil, metals, or growing crops. Companies at this stage supply the basic building blocks for everything else. Next is manufacturing, where raw materials are turned into finished products. This involves factories and workers adding a lot of value to the raw materials. After manufacturing, goods go to the wholesale stage. Distributors and wholesalers are like the middlemen, connecting manufacturers with shops. Finally, the resale stage is where we, the consumers, come in. Shops, both online and in person, sell the finished product to us. Understanding this chain is like having a map of the industrial landscape. It helps you see which parts are likely to grow based on economic trends and leading indicators. By investing in companies at different stages of the value chain, you can spread out your investments and potentially earn more. Let's see the value chain in action with a real-world example, the semiconductor industry. This industry powers our digital world and shows perfectly how the value chain works and how investors can benefit from understanding it. The journey starts with raw materials like silicon, which comes from sand. Mining companies dig up this important element for semiconductors. Next, the silicon is turned into sophisticated chips. This stage requires high-tech equipment and adds a lot of value. These chips then go to electronics manufacturers who put them into things like phones, computers, and cars. This adds even more value. Finally, these devices get to us through online shops, electronic stores, and mobile phone companies. By understanding this chain, investors can find potential winners at each stage. For example, if demand for electronics goes up, this could mean growth for silicon mining companies, chip makers, and device manufacturers. This knowledge helps investors choose the right companies and benefit from industry trends. Section 5. Investing along the chain, identifying opportunities. We now understand the value chain, so how do we use it to make better investment decisions? The key is to find out which stages are likely to grow based on economic indicators and industry trends. Let's say the indicators suggest a lot of new construction projects. This could mean more demand for steel, which is good for mining companies and steel manufacturers. Similarly, if consumers are feeling confident, This might mean more sales for shops, creating opportunities for investing in retail companies or online marketplaces. Remember, each stage of the value chain has its own risks and rewards. Mining companies can make a lot of money, but they're affected by changes in commodity prices. Manufacturing depends on efficient factories and skilled workers. Retail faces tough competition and changing customer preferences. By carefully looking at leading indicators and understanding how each stage works, you can find the best places to invest. It's like having a treasure map, showing you the most promising opportunities in the market. Section 6. Diversification is key spreading your bets. Don't put all your money in one place, especially when investing along the value chain. Spreading your investments across different stages and sectors can reduce risk and potentially increase returns. Imagine this, if you only invest in mining companies and the price of metals drops, your investments could lose value. But if you invest in mining, manufacturing, and retail, you're better protected. Also invest in different industries. Don't just stick to technology or healthcare. Look at opportunities in energy, consumer goods, and other promising areas. Remember, spreading your investments doesn't guarantee profits or remove all risk, but it's a basic rule of smart investing, acting like a safety net and potentially making your investment journey smoother. Section 7. Stay ahead of the curve. The importance of staying informed. The investment world is always changing. Staying informed is really important for making good investment decisions at the right time. As they say, knowledge is power, especially when it comes to money. Make it a habit to follow financial news, read industry reports, and track economic indicators. The more you know about market trends, the better you can predict changes and adjust your investments. Pay attention to news about technology, new regulations, and world events. These things can have a big impact on industries and create both good and bad opportunities for investors. By staying informed and ahead of the game, you have an advantage, letting you benefit from new trends and avoid potential problems. Section 8. Putting it all together, a winning investment strategy. We've talked about leading indicators, the value chain, spreading your bets, and staying informed. Now, let's combine all of this into a winning investment strategy. First, keep a close eye on leading indicators like the ISM reports. These give us valuable information about the economy and potential growth areas. Second, use the value chain to find specific sectors and companies that are likely to benefit from these economic trends. Look at each stage of the chain and find the best opportunities. Third, spread your investments across different stages of the value chain and different industries. This helps reduce risk and potentially improves your returns over time. Finally, stay informed. Keep up with financial news, industry reports, and market trends. The more you know, the better you'll be at making smart investment decisions. By using these ideas, you create a strong plan for navigating the market and potentially reaching your financial goals. Section 9. Time to act, making smarter investment decisions. We've covered a lot, from leading indicators to the value chain and staying informed. Now it's time to use this knowledge and start making smarter investment decisions. Remember, investing is a marathon, not a sprint. It takes patience, discipline, and a long-term view. Don't get distracted by short-term market changes or emotions. Focus on building a diverse portfolio that matches your financial goals and how much risk you're comfortable with. Use the tools and strategies we've discussed to find good investment opportunities and navigate the market. Start by researching different industries, looking at companies, and tracking economic indicators. The more you learn and use your knowledge, the more confident you'll become in your investment decisions. Remember, you have the power to grow your wealth. Take control of your financial future, start investing wisely, and let your money work for you. Don't forget to like and subscribe to IBF channel for information.